Good morning, good afternoon, good evening, everyone. This is Joseph Trevisani from FXStreet and Worldwide Markets with another edition of Market Directions Interview. Today we are welcoming, and I am certainly welcoming, probably one of the best known and most successful currency analysts here in New York, and I think around the world, and an old acquaintance of mine. Boris, how you doing?
I'm great. How are you, Joe?
Not too bad. It's kind of fun to do this. I've been enjoying it. I really thank you very much for coming. You've always made a good conversation, and even if our conversations tend to be pretty lively, let's see what we can do today.
Yeah,
we spoke the last time we were on together about the U.S. election, about what was happening then, and we've seen a real play out since then. We had this long and very powerful Trump trade. In the equities, the Dow gained about 18%. The S&P gained 15%. The dollar also has been powered by all of this. Now, we've seen a good portion of that given back. What do you think is happening here? It's almost like the Trump trade is dying by the death of 1,000 cuts. But not really that much has changed economically.
No, but the Trump trade was never about economics. It was always about politics, and it was always about politics changing economics. And I think the interesting thing about the Trump trade is that currency market that was the first one to reject it, the first one to basically, in other words, peaked all the way out in the middle of December of 2018. Equities have been rising up and up and up and up. Like equities have been going higher even since the start of the year. They really haven't been affected by this kind of a slowdown. But dollar yen has peaked, signaling perhaps that the market, especially the currency market and the bond market, are just not buying the whole idea of 3% growth, basically based upon a couple of suppositions. One, that regulatory reform, which is going to essentially unleash tremendous amount of economic activity.
Nostalgia about that.
Right. And in addition to that, there will be a massive infusion into very, very necessary infrastructure investments, maybe as much as $1 trillion. Bridges, tolls, and even non-physical infrastructure, which is internet, the backbone, all these things that I think the country clearly sorely needs. So what's happening is that the market very much anticipated all those things going, and at 3% rate, you can imagine a 3% growth rate. That, of course, connotes that the Fed is going to raise rates much faster, that U.S. yields are going to go up, the dollar is going to attract a lot more capital because now we're going to be sort of the leader in the G7 world as far as yield goes, blah, blah, so on and so forth. Well, a lot of those assumptions are starting to fall by the wayside. The first and foremost of which is that the failure of the reform of the healthcare plan appears to have really stumbled the Trump administration right now as far as their next step, which is getting the tax reform done, and more importantly, getting the infrastructure spend done properly. And they seem to be just kind of in a Washington D.C. quagmire, very much the swamp that he was trying to extricate everybody from. As a result of that, the actual underlying economy in the U.S. At any kind of a robust rate, it's doing well. We are doing okay, but it's a fair to midland growth of about 1% to 2%, 1.5% to maybe 2.2%, none of which really creates any kind of a condition for uber strong Federal Reserve tightening policy, yield going up, and all those things. So there's a big disconnect between, I think, the expectation and the reality of what's happening on the ground. And the first market that is sensing this disconnect, in my opinion, is the currency market and the bond market. I've always said that the bond traders are the smartest guys in the room, and they were the first one to sniff out that there really is no there right now. That could change. I'm completely open to the idea that things will change, but I think the thing to watch in the second half of the year is not going to be the economic data. Economic data is just going to be pretty much as is. It's very much Groundhog Day. What's very, very important to watch is the events in Washington, D.C. President Trump is going to make the adjustment in the legislative tactics to get stuff done. I think he clearly wants to get stuff done. It's going to be interesting to see if he can get that done. And that would be, if he does have a second act, that would be a huge, then I would be right back in $1. I think the equity markets, gets a third wave of buying, and bond yields go back up.
You can, there's that old line from Bill Clinton about, when I come back, I want to come back as the bond market. They have certainly not taken.
I'm sorry, you're breaking up a little bit, so I can't hear you very well.
I know, it's on this end too. I'm not sure what it is.
Okay.
Let's see if we can, wonderful
go ahead.
technology, but it is imperfect.
Yes.
Maybe it's a mirror. It's a mirror of the human condition. The bond market is certainly not buying this entire reflation trade, the Trump trade. They haven't really very much from the beginning, because the bond market rates have more or less come off over the past, slowly, but over the past 3 or 4 months. They have not bought it. The currencies and the equities went off on their own. Currencies are coming back. You've said that you think that it's possible that the Trump trade reflates if some stuff gets done in DC. Primarily, just look at what they're talking about now. You keep hearing comments coming out of various politicians that the healthcare is being taken care of, or at least being attended to in the background. If the Trump administration, I agree with you, we're talking about politics here, not economics. If the Trump administration gets a health care plan through, whatever it is, and honestly, from the market's point of view, I doubt it matters very much. And if it gets some sort of start on tax reform, could we see this come back to with the levels that we saw before or right after the election?
Yes, I think we can, but I'm afraid that their tactics, I guess, maybe I'll put on my political hat for what it's worth, and I'm clearly not a political strategist, but just as an analyzing it from my perspective, I think it's I think the healthcare story is a huge loser. Trying to reform was a massive disaster, because the Affordable Care Act actually is a very, very popular act in its delivery of benefits, not in its cost, but it's in delivery of benefits. And by trying to reform they basically had to take away benefits, which is the one thing that everybody in the Affordable Care Act really, really likes. So whatever they come up with as a reform will inevitably be a worse version than what it is now, and therefore create a lot of negative feedback, in my opinion. And more importantly, I don't think will pass, because even if the conservatives support it, for them to make it attractive for the conservatives, they'd have to make it so draconian that the moderate Republicans will not support it. And I just think it's a complete loser. And I'm surprised that President Trump, who in my opinion, I actually wrote a column last week saying that everybody should day trade the way Donald Trump. If you want to be successful day trading, you should be like Donald Trump. Because the one thing about, love him or hate him on a political spectrum, the one thing that Trump does well is he cuts losers. Like when something doesn't work, he just walks away from it. He completely walks away from it, which is one of the reasons why he drives everybody on the right and on the left completely crazy, because he can change his opinion 180 degrees if he doesn't think that's the right opinion. And he doesn't really hold on to it. Right, he doesn't hold on to any kind of dogmatic point of view. And so that's what surprised me, because I think it's far more intelligent to just forget the healthcare issue and see if you could work on some sort of a reasonable tax reform issue, because then the market really will feel the love. Now, clearly he's got a lot of difficulty, because he's got to navigate the whole complex Republican structure in Washington, D.C. And I think, this was a big lesson for him. But I think that's the problem. And the longer they kind of wait, the longer they do if this, then type of a tactic, I find it very difficult to believe they'll achieve anything. And if they don't achieve anything, then we're right back to no Trump trade. I think that's sort of the takeaway that I'm involved with.
The thing that I look at, though, when I look at I don't want to spend too much time on DC politics, because you and I could do politics for hours without there being any delay, and we would enjoy it.
Without coming to any agreement.
No, we're not coming to agreements. That's not the point. It's very enjoyable to listen. The problem I have with the tax proposal. And I agree with you that that will deliver more real benefits to the economy, potentially. And certainly it'll get more market action. Is that the same types of difficulties that the Republicans are going to have with their coalition, which is essentially what it is, that they had with healthcare, they're going to have with tax proposals. And tax proposals are just, if not more complicated.
Yes.
So I'm concerned that the movement forward, that they need to build momentum, political momentum, regardless of how they do it. And I think you're probably right that the healthcare thing is at best a 50-50 or worse proposition for them. But will they be able to get movement on tax reform without building some sort of political momentum with something prior, which they mistakenly or not laid out on healthcare?
Actually, I think they would. I mean, again, we're not political strategists, although we play play on TV occasionally.
Oh no, we are. We're political strategists.
I think they actually can if they need to change the narrative. The narrative just needs to go away from healthcare to how can we make American business competitive in the global economy. That's a very compelling message. It's a very compelling message. It will resonate, I think, across the broad swath of the country, not just the sort of the conservative part of the country. And they can shepherd it. They may even be able to, if they do it properly, get some moderate Democrats on board. So it's a question. A lot of it, I think, is a function of who runs policy. Gary Cohn, who is a Goldman Sachs guy, who's about as inside the Beltway and inside politics you can get, is actually, in my opinion, the right guy to get this done. The critical question is, I thought, by the way, sort of one last Washington takeaway, but I think it's an important one for investors to consider. I thought the biggest story over the last week and a half wasn't North Korea, wasn't Syria, wasn't the healthcare. It was the fact that Steve Bannon got banished from NSC. And to me, the single greatest upside to investors is if Steve Bannon is fired. If he's gone, that means the whole moderate faction of the Trump administration, the Gary Cohn part of the administration, who really know how to run the economy, begin to take care of policy. And I think that's something to watch for very carefully.
Yeah, it is true that Bannon is primarily a political operative. That's really what he does, and he's more interested in health. But to move on, we've seen in the past 2 weeks a rather large jump in the VIX. Went from about 11.2 to about 15.5 when I came in just before this interview. What do you think that represents? You think that represents the French election, Korea, Brexit, Syria, all of these things? Or is the market returning to the idea that the world has not really gone away and we have this little, we could ignore things that were going on in the powerful aftermath of the Trump election as far as the markets go, but now we're getting a focus back to where things really are?
Yeah, I think it's that. I think the VIX is representing, a dose of reality, that the problems still remain, that there are flashpoints all across the globe that are not 100% certain to go away. I mean, Korea is just one of those flashpoints that nobody knows what happened. I mean, because Korea is the most unpredictable, right? Imagine if Kim Jong-un decides to just lob, one of his missiles that goes 20 yards into the ocean. But just if he decides to do that right now, while we have the carrier group in the ocean, what if he decides to lob a missile at the carrier group? I'm sure we'll be able to swat away like a fly, but just him doing it is going to be an interesting move, because then it becomes a macho contest between him and Trump. So I think those flashpoints are very real, and I think that's the VIX is rising in anticipation of that.
We've noted in our conversations and you've noted that monetary policy seems to be dead. There's very little that it can do right now to affect some of the things that are going on in the world. With all of the rates still at their abnormally low levels, even in the United States, which has made some move to get back to more normal levels, whatever they are.
Right.
Nobody apparently knows what the neutral rate is, and it's kind of an academic concept anyway. Are we going to see a progression in all rates back to normalization, regardless in the country? For instance, the United States economy hasn't improved a whole lot. It's been going along like it has been going along. Yet the Fed now seems determined to raise rates. Is that idea going to carry over to, say, to England, Great Britain, to the ECB, and to Japan?
So it's interesting that you leave Japan as the last because I've been making this argument for the last 10 years, and it's frightening at how accurate it's been. It's just sort of been this whole thesis. My whole thesis is that we're all turning Japanese, not in a good way. Meaning,
and this is if you're stealing this from the vapors, you know that.
Right. Yes, that's exactly it.
There you go.
Stealing that song. We're both old enough to actually remember that song. That's dates us both.
That is true. It's fortunate, but it's true.
Right. But the principal thesis behind that idea is that we're never, or at least in our immediate lifetime, going back to what we would call normal monetary policy, where we see rates going to 3 to 5%. We have a 3.5% nominal growth rate, and we sort of have these pockets of maybe even 4 or 5% growth rates across the Western world. There are massive forces aligned against that type of scenario. Demographics, the fact that all of the Western world is getting much older and therefore much less productive. The brutal mechanization and electrification and computerization of all human activity, meaning that robots. I was just reading a story today about a Chinese factory that now has a whole bunch of robots that do basically it's a logistics factory, and so they have to move these packets around. And the robots read the code, the barcode on the packet, much more accurately than a human being is. Shove it across to whatever chute it goes into, and is self-charging, so it can work 24 hours a day. Right now, they have them working 7 to 8 hours a day, but you can just see the future coming, and it's a future of relentless low costs. So under those conditions, it just seems highly improbable to me that we will see this kind of normal activity that we saw in the 20th century. I think the 21st century is one of perennially low interest rates. So 1 or 2% is about all you can aim for, which, by the way, I think is a really interesting point for longer term investors, because I think it presents some massive challenges for all of us. We are living longer, and we're going to be earning less on our pension funds, because yes, I know so far that hasn't happened. That is, stock returns have been pretty good in this decade. I absolutely 100% believe that's not going to be true. I absolutely 100% believe that the next 10 years, we're going to see 3 to 5% cumulative growth in stocks. So you're going to have this incredible, I think, point of stress for investors where everybody lives longer and the money is not there because interest rates are not going to be there, because returns are not going to be there. I think that's true. Sorry?
It's true for economic reasons as well, because you have all of these institutions across the financial institutions that depend on matching their liabilities and their assets across many, many years.
Right.
And they are trying to transition now. Life insurance companies are probably one of the best examples of this. Right. They're trying to transition from this world where they could earn and they could project 3, 5, 7% in returns to something much, much less than that, less worthwhile to the individual buying them because they pay much more money.
Right. The mismatch between pension liabilities and the pension funding is just going to be a massive story as we go forward. And
it's a very powerful story for the economy as well.
Right. And it's one of those kind of stories, that nobody really pays attention to because it's so slow moving and it's really decade long in development. But when it hits, it's going to have, I think, very powerful forces. But to go back to the more immediate point, what happens to monetary policy? It's 50 basis points a year, and then we stop. That kind of thing. I think you're seeing that the Fed went from we're going to do 4 rates, to we're going to do 3 rates, to probably we're going to do we're going to do 2 more rate hikes. That's it. We're going to tap, and they keep even they themselves keep saying our terminal point, that is our maximum point of where we're going to stop, is going to be considerably lower than what it was normal. And I think that's a reasonable assumption. ECB is still negative. ECB is still trying to crawl its way back to zero. So you have 3 of the world central banks essentially, nowhere near where they need to be as far as yield goes.
And there's been I've always wondered why some of the central banks, they look at zero rates as sort of some sort of, if not panacea, at least a necessity for the time, wondering about whether this policy will work, but they don't really have to look very far afield. They can look at Japan.
Yeah.
Japan has had this issue with deflation and low prices and low productivity and zero rates essentially for almost 20 years. Not quite, but close to it. And it hasn't sponsored economic growth. It doesn't seem to be the type of policy that will do that.
I don't know if this is the right analogy, but I think it's an interesting one. The whole story with QE very much reminds me of two types of traders. The trader who has a bad trade and he just stops himself out. So he takes the loss and then he's fresh, he's got fresh capital, and then he can go back to trading, and he sort of like within a year or 2 years, he recovers his loss and he's doing well. And the second type of trader that never, ever wants to take the loss, that just keeps adding to his position. Now, he's got an infinite bankroll, so he can just keeps adding to his position, adding to his position, adding to his position. But what's happening is the position never rallies to positive, and he's never able to recapture his account equity because the market just isn't there, because he's carrying all this heavy weight on his back. And I kind of think that that's sort of, on a global scale, we've just been delaying the necessity. We all know, Joe, you and I are both sort of small students of history. We know that default is one of the greatest economic regenerators ever. Anytime somebody defaults, because you basically wipe the slate clean. Yes, all the creditors get killed, and there's a massive, essentially, wealth redistribution. But what that does is it creates whole new opportunities of investment, because you're not carrying that debt on your back. So, and there's two ways of defaulting. There's the pure default, or there's just simply hyperinflation. We just inflate the whole thing away. It seems like maybe that's where we're going to go. Maybe eventually that's where we're going to go, because I don't think any of the policymakers are going to be willing to take a default as an option.
Having remembered just briefly my days on the bank trading desks, your analysis is very accurate. But the worst thing you can do is keep averaging on a position and expect it to turn out. The old line is, don't turn a day trade into a strategic trade. It never works, and it never does.
It never does.
The last topic I want to touch on before we run out of time is the European election. When we spoke, you mentioned, and you're correct, that more than 40% in the latest poll of the French electorate now, as in a poll of a few days ago, seems to be seriously willing to consider getting rid of the euro and perhaps the EU. This is an astonishing development. You talk the 24% for Le Pen and the 18% or so for a man whose name I'm not sure I can pronounce.
Mélenchon.
I knew you could do this. That's an astonishing development for the political project and for the EMU project. It mirrors, in a way, the resentments that we saw in the last election here in the United States, both on the left and the right.
Right.
There is something clearly going on with industrial societies in the West and their electorate. Do you think it's really possible that that we end up with between those two extremes? And what will this mean for the euro and the currencies?
So the conventional answer is no, that we survived, that we sort of survived this particular bout of populism in France. Right. And that Macron stumbles his way, or he's actually done a very intelligent campaign, but he basically manages to kind of hold everything together. But I think the point being is that the underlying forces, unless there's some reform in the system, are just not going away. Everybody, again, the irony of the whole thing is everybody knows what the reforms are. You and I know within 3 sentences what needs to be done. You need to have a common treasury. You need to have common risk sharing, and ideally, you need to have, and this is something that they all hate, but they all gotta do it, a common tax authority. They basically got to let the Germans collect the taxes for them, but that is the ultimate affront to all. I mean, if the Germans collected taxes in Greece would not be would not have a problem, but God forbid that they all do that. And so until they kind of even just move towards that direction, it becomes quite difficult. I think the problem is that, and sort of a little bit of a side point, I read an interesting article today from the Harvard Business Review that talked about the lower to middle class Americans and what the real problem was. And it was a brilliant insight. What they did is they studied every single dollar about 300 families spent over a period of 6 months. And their insight wasn't the fact that people did not have income. It's that they didn't have cash flow. That what happens is on the lower stratum of society, you get sick, and it's an $8,000 hit to your needs. Your car breaks down, and it's $1,000 spent. And if your cash flow is, let's say, $1,000 every week or so, it becomes an incredible volatile problem. And more importantly, the cash flow is not consistent. In other words, most people in America these days don't earn a steady paycheck. It's kind of a gig economy. It goes up and down. So some weeks you earn 2,000, some weeks you earn 1,000. And that level of intense uncertainty, which is exactly what what all of us know is a serious problem.
No question.
That's what's really driving this populism impulse. And I thought that was really interesting because I think it's happening in Europe too. Europe has a much greater social net, safety net, but I still think that the variability in cash flow is what people are completely missing about the political issues here. And sorry, did you want to say that?
No, it's good. One of the things that I think, as currency and economic analysts we have to deal with, is that the likely result of the election this year is going to be a huge boost for some seriously non or anti-European ideas. And that is going to have its effect in the currency markets, in the bond markets, and everywhere else where we have to deal with it, because this stuff had never been mainstream before. The euro and the EU has always been within the media an accepted future where there are no questions in Europe.
Right.
That is becoming a seriously questionable proposition. This portends a good deal of volatility, I think, in the future that we have, or certainly on the currency side.
Well, I think from a trading point of view, what this portends is a very real possibility of euro-dollar parity. Something that, we've been talking about it for a long time. It hasn't really at all happened. But, we are quiet, but close. And when I've learned that when prices are quiet and close, you want to be prepared for the move. I think there's a reasonable chance here that if we get serious volatility in Europe, maybe even a genuine threat that Le Pen has let's say we have a Le Pen Macron runoff, and she pulls God knows how Mélenchon's votes. Let's say the left doesn't give all its votes to Macron. It becomes a very, very tight race, and the euro could really come under a lot of pressure. The closer we get to parity, the much more likely it gets there because the speculative flows will push it. Remember, there's two realities in trading. There is the sort of universal reality of economics, and then there's the price reality. And the closer we get to the price reality, it becomes reality. Price becomes its own reality.
Absolutely true. Yeah. There's one other topic I want to bring up before we end here, and that is it's on the same topic, but we're going to have three major elections this year in Europe. We had the Dutch, we're going to have the French, we're likely to have an Italian election. The polls in Italy are more anti-EU than they are in France.
Correct.
It's an incredibly volatile situation as far as politics goes, because the man running it is not essentially a long-term politician, nor does his party have any real political structure.
Right.
But the protest vote is powerful. So even if the euro survives Le Pen and the rest of the French election, it then has to face the Italian election this year. How do we keep euro from parity? How does the euro stay away from parity with that kind of pressure pending on it?
It's all going to be poll driven. It's all going to be contingent on whether there is a palatable mainstream candidate in Italy. The way to usurp the protest vote is to become a reform candidate. The template, the template has been set by Macron, who basically came out of nowhere and said, "Hey, I'm not emboldened to anybody. I am a new guy. I believe that we can reform the system from within. I'm willing to try anything, and I feel your pain. The Billy Clinton line. I feel your pain." The problem is, I think a lot of European politicians are just not as savvy to that message, and I wonder if Matteo Renzi certainly was tone deaf in trying to do this. Whether he'll be able to kind of reformat himself as a complete reform candidate. Italy is a mess always. In the best of times, Italy is always a mess because Italy is just a bunch of feudal fiefdoms, mildly united by a common language. Right? We've been to Italy, and northern Italy is Milan is much more is essentially Switzerland. And Sicily is basically sub-Saharan Africa. It's just that they're so widely different in a lot of their culture that it's hard to keep it together. In the best of times. So yeah, I think Italy poses that big threat. It's going to be very much interesting to see. I think you're right. I think the whole story in the second half of the story it's all going to be a political story. In the U.S., it's going to be a story of what Trump can accomplish. In Europe, it'll be a story of how they can keep it together. Can they keep the union together? And I think those two big themes are going to be the big driving forces for how we trade.
Boris, we have to go. The time is up, but I thank you very much for coming. One thing I think we can be sure of is that this is going to be, as they like to say in that old fake Chinese curse, because it's really not. It's made up by some Western guy. May you live in interesting times.
Yes.
And I think we do. Boris, again, thank you very much for coming, and I'm sure everyone will very much enjoy what you have had to say today. It's been a pleasure.
Thank you so much, Joe. As always, great to be with you. Take care. Bye-bye.
Take care.